Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. So the story around debt. Recently, we had a client that actually has been a client of ours for probably 8 years, had acquired a number of different debt items. Probably the biggest one being some credit card debt, some automotive debt. Obviously, they had their house and their mortgage on their house. So I had a list of debt that was out there. And so the idea was, what if we could take control of all that debt? That was the original idea behind this infinite banking concept. And so we had a conversation with him, or I had a conversation with him, where we said, okay, let's do this in a process. First is to identify all the debts. Second one is saying, what is the most harmful? And what I mean by that is most harmful debt being those with the biggest payments based on, as a ratio to the amount of debt that they have, and as interest rates, because interest rates are obviously playing into the amount of payment. And so once we listed that amount of debt out and we ranked the debt, we said, let's take control of the debt. Let's bring it inside. So we looked at the policy that we had, the client had built, because they had built up the capital inside their policy. And we said, well, first thing we're going to do is take number one debt. The $28,000 on a credit card debt at 23% was outrageous. And so we took that debt, borrowed from the insurance company, ran it through their family banking system, paid that debt off, and then turned around and paid back their family banking system that same payment. We can run the truth concepts on it and say, what does that payment look like? So that was the first story. It's like that was the first piece of debt. And then the next one, we said, okay, we have some other debt at a fairly high interest rate. And as that payment for that credit card was coming back into the family bank, we had more reserves. Now we could go and take and tackle the next piece of debt. So it was a strategy of saying, what is the first piece, taking it, paying back the same payment, because we're willing to pay American Express that $1,000 a month payment. So why wouldn't we pay that back to our own family banking system? So we're willing to do that. We're making it continue to make that payment, but now it is back to, I think this is the real key, back to a system that we own, where we own the dollars versus manage the dollars. We own the debt versus managing the debt. And once it was flowing back to us, we said, okay, now once we have control of that credit card and we have payments going back, let's take a look at the next piece of debt. And the next piece of debt was some consumer debt. So we took a policy loan, again, had that loan paid to the family banking system, checking account number 2, paid off that debt, and also now that same payment was coming back to an entity that they owned and controlled. And so after about a 6-year process, again, we had to map this out. After about a 6-year process, the client now was in much better shape. We didn't eliminate the debt, at least initially we didn't eliminate the debt. We just transferred who had control over it. And I think that's the big key, is that we transferred who had control over it. And so, and that took some time. It wasn't like it was automatic, and it wasn't like we eliminated it. It still took the discipline of paying off that debt. Again, we have to love our family and ourselves more than we love Wells Fargo or American Express, whoever it may be. So we have to continue to pay that debt off. And so that was the first case. Second story, I had a client who was putting significant dollars into his policies. It was $100,000 per year that he was putting into his policies. Now, again, we don't have to do this. The first story we were telling, it was close to the client was putting about 15 grand into their policies. So it doesn't have to be $100,000 to make these things work. It's just whatever works and whatever makes this significant within your financial life. A lot of people are scared of premium, but those that understand IBC know that premium is the solution. It's not the problem. And they're not afraid of paying premiums because they understand that that's their gateway to finding that freedom that they're looking for. So with the second one example, we came out, here's a gentleman that had policies on him and his wife and his kids. And so he was putting significant premiums into his policies, knowing that he wanted to control that banking function in his life. And he wasn't using it to finance cars or other consumer products. He was using it really to help run his business. But more importantly, what happened was he had it as his cash reserve when he was building his vacation home. And so he was using his vacation home as a VRBO, but like anything else, like most construction projects, it ran into a snag, and then they wanted some additional capital to finish up, and the bank says, we're not going to put any more money into it. So he turned to his policies. And luckily, he had enough money in his policies. Quite frankly, he had enough money in his policies to pay for the entire $1 million project. But he didn't want to use up all $1 million, so he continued to use the bank's money, and he used the policy to supplement those additional dollars that were the unforeseen cost, which took all the stress out of the build for him and his wife. And so this is the true sense of, it can be the seen, but a lot of times it's the unseen. And when they knew they had the reserve dollars to make up the difference because they changed the marble countertop that they had, some additional cost to that. So now they had the reserves to be able to back it up. And so what happened was, as they went through the process, they didn't have to sell other things, they didn't have to leverage anything else. They already had the reserves. And so when the bank pushed them a little bit, like, hey, we're not going to finance that part of it, they didn't have to make a choice of either we were going to add this part during construction or continue to do it at the level that they wanted to do. They said, okay, fine. They just made the decision to go to their family bank and get a loan from their family banking system because he was the person that was controlling the financing in that sense. Third would be, I had a client actually started out with one small policy. He was putting about $8,000 a year into his policy. It was actually maxed out. Maximum coverage that the insurance company would allow him to have based on his income. And so he had $8,000 that he was putting away, and then along the way he's like, I want to start buying real estate because I think that's my pathway to wealth. And so he bought his first piece of property. He needed a down payment. Where did he go to get the down payment? Went to his family banking system and said, okay, I need on a $100,000 piece of property, and the first buy he need $10,000. Just so happened that he had had his policies for 3 years. There was $12,000 in there. And so he was able to borrow the money from his policy for his first real estate purchase. A year later, he's like, I want to buy another one. And he had been disciplined, paid back his loans from the cash flow of owning that property and continued to pay his premiums. And so he grew to the point where he could make his second purchase of real estate. Again, this one he needed about $15,000. There was another house, but he needed 20% down, and so where the price of that house was and where he lives, he needed about $15,000. Well, again, he paid enough back because, again, for every dollar that he paid back into his loan repayment, it freed up $1 to take out another loan. So he paid back the loan that he had, freed up enough dollars, he put enough new premium going into it to where he can say, hey, I can take and buy my next house. Again, this seemed like he was playing small ball, but what ended up happening was he found a piece of land that was for sale. And again, it's not always about the seen, it's sometimes about the unseen. And he goes, it was a piece of raw land on the edge of town. He thought, maybe I can buy this and see what happens. So he purchased the land. He actually, the bank kind of gave him some pushback. It's like, hey, we don't think we want to finance this. There's no cash flow to it. It was what I would consider relatively inexpensive. It was very inexpensive, quite frankly. But again, the bank didn't see any cash flow to it, so they were a little bit nervous, so they were going to pass. So he came back and he did a HELOC on one of his other properties, bought this piece of land with he and his brother, and decided to hold it because they could see the town was expanding that direction. Fast forward 2 years, all of a sudden he's got a big box store, retail store, knocking on his door saying, hey, we would love to be able to purchase this land. So the client now is in the driver's seat because now he's got a big box store. He bought the land for $15,000, and they're offering him 100 times that because it was in the right location, and he took an opportunity. He took the opportunity. Again, he had certainty where he had money, so he was able to take the risk to be able to purchase this land. And the risk wasn't so bad because, again, he wasn't obligated to having a payment. He wasn't obligated to making that payment each and every month. He was the banker. He understood it. He knew he was going to have to hold it for some years. And then he had no idea that the big box store wanted to buy this land. He just could see that it was an opportunity, but he wasn't sure how long he was going to have to hold it. So that time to hold it was the thing that the bank didn't understand. And so what he did is, like, he went and used his policy, borrowed against it, bought that land, brought his brother, his business partner in. They purchased the land. And then now what happened is, like, his big box store offered him 100 times, or excuse me, 10 times of what he paid for it. And they ended up settling for about 20 times what he paid for it. Again, it's not always the seen, it's the unseen. It's the taking advantage of opportunities when nobody else sees it or can take advantage of those things. Because remember, the bank wasn't willing to give him a loan. So he had to go to an alternate source to be able to buy it. And then he structured the loan to say, we're going to pay interest only on this piece of land until we know it can pay off. And it paid off big time. So he went from buying less than $100,000 rental properties, trying to do a flip or trying to rent these houses, to buying land that had a huge return because he was able to take advantage of an opportunity. But all that started with that first policy that he started, relatively small dollars going in there. Here's a guy that was making $50,000, $60,000 per year. And he put some money in his policy. He understood that it's a long-term game that he's playing. And now, 7 years later, he owns a number of different policies because now he had more income, so he took additional policies. And so he has multiple policies over his lifetime. Client that purchased real estate in Las Vegas. We had a client that had an opportunity, and this was in 2008 and 9. The conversation was, he had the opportunity to buy a piece of real estate in Las Vegas where he wanted a house. And so as he was looking at it, and this was in the early part of 2008, and housing, if anybody recalls, their housing was going for crazy dollars. And he looked at it and he said, I can't justify it. I'm not going to pull the trigger to buy this house. Although the bank was willing to give him the loan on this property that was probably at that time valued at about $450,000. And so he passed on it because he thought it was outrageously priced. Into 2008, all of a sudden things are starting to really come apart in the real estate world. That house that was at, we're going to call it $500,000 just for simple math. That house that was at $500,000 is now being listed, and they're wanting to sell it at $350,000. Great opportunity. But the client goes, I don't know what's going on. There's a lot of uncertainty going on in the world right now. Maybe I should be better served just to sit on my cash. Wise move. Again, his policy, the cash value in his policy has the certainty that he wants. Another 2-3 months goes by. All of a sudden, the house that he was looking at, the realtor says, hey, they're doing a short sale. We could probably pick this thing up for around $250,000. He goes, that's great. Let's see if we can take some action on it. But the problem was, what bank was going to lend him the money? At that time, banks had shut down lines of credit. They completely put the clamps on any new lending. If anybody lived through 2008 and 9, they realized that happened all the time. Lines of credit were pulled. People with great credit ratings, lines of credit were pulled. So what happens? He goes, gosh, I wish I had the ability to buy this house because now it's on sale for about a 50% off. I said, you have that kind of money inside your policy. Because again, when he originally started looking, his policy was not really designed. He hadn't designed his policy to buy a house. He was using it to take advantage of other opportunities. But now the opportunity was there. And he says, I can just go ahead and take a loan, a policy loan. He says, absolutely. All you have to do is fill out this paperwork, and there was actually about $200,000 in there. So he made an offer of $200,000, and they sold it at $220,000 on this house. That piece of property is well over $1 million today. In today's term, at the time we're writing this book. The point being is he took his money where there was no restrictions, little restrictions. He had to put up the cash value in his policy as collateral, and he took advantage of that opportunity to buy that house. His house, his what he called his retirement dream house in Las Vegas, when nobody else was willing to lend the money, when nobody else was able to purchase anything else. he had access to an unrestricted line of credit, a guaranteed line of credit, and purchased this house for $220,000. He had to max out his policy loans to be able to do it, but then we set him on a payment schedule, say, hey, let's pay this back. And let's assume that it was the original $500,000. And so we could get his loan paid back at a lot quicker rate because we just ran it with the amortization schedule at $500,000, and we can run that. And that was his payback rate for his house. Same payment as a $500,000 one. Let's talk about another situation in a business. Well, let's talk about maximizing a retirement benefit. This was really an interesting story. I had a gentleman who he works for the federal government. Let's put it that way. And they have great retirement benefits, by the way. So he had great retirement benefits, but wasn't sure how he was going to do that. But he liked this idea of infinite banking. So he had set up a policy, had it for 4 or 5 years, and then it got around to the time where he says, I'm tired of the bureaucracy of the federal government. Maybe what I'll do is I'll retire, because he can now retire and come back as a contractor for the government to do the exact same job, but now he's an independent contractor versus an employee. Now, one of the really nice things that he was in a position to do, he says, I can take a pension. I can take my pension, I can start drawing on that. So we had conversations around how we could do that. And I said, well, one of the side benefits that you have of your policy is that you have the certainty of a death benefit in your policy. That's, again, it's a life insurance policy. So you have the certainty of that death benefit. So when we started looking at it, I said, because you have that death benefit and that certainty of that death benefit, we can maximize your pension plan. And you can do a lifetime only pension plan, which added about $600 of additional income to his monthly pension benefit. I mean, how fabulous is that? By actually having that policy in place, and he was already using his policy to save and give him that certainty that he was looking for from a saving standpoint, and also from being able to use it to having some debt strategy, and actually he was doing some hard money loans to other people. He was now able to take advantage of maximizing his retirement because he had a guaranteed death benefit. So if he would pass away, his wife would be guaranteed a payment from the insurance company. Now, it wasn't from the government because he took a lifetime only payment from the government, but now he had this death benefit that would be guaranteed. Now, more than likely, odds are telling us that he's not going to die anytime soon. He's got another 30 years. And if you do the math, $600 a month is $7,200 per year times 30 years, because that would be his normal life expectancy. There's over $220,000 of money he would have left on the table had he not had that life insurance policy. So there's just an example of, I would call it an ancillary benefit if you have a pension plan and be able to do that. And the same thing works if you have a 401k plan. Again, having a safe, secure, guaranteed asset in a life insurance policy gives you options when it comes to taking retirement distributions from your 401k or setting that 401k to pay a lifetime payment. So there's some options versus having all in the market when you have safe, secured, uncorrelated assets to the market. We had another individual who ran a small business, he and his partner, and they wanted to retain some of their key employees. But they also understood that access to capital, access to money when they want it versus when somebody else wants to give them permission to use their money was vitally important. And so they said, what can we do here? We like this idea of infinite banking. We like this idea of having access to a pool of money and putting it to work like banks do, but we want to run that operation through ourselves. We want to be owners of that capital. We want to direct the flow of that money back to ourselves versus having that money flow to Wells Fargo. And so the idea was, well, if you got some key employees, first off, let's take care of the ownership, because there's 3 things that are going to impact a business. We want to protect capital, which is what they want to have the conversation. We want to protect and retain key employees, and we want to protect and retain the owners of the business, because those are 3 things. With lack of those 3 things, that's why businesses fail. Lack of capital, lack of good, talented individuals, and then lack of the ownership structure staying in place. And so by applying for and getting policies on the owners as well as the key individual, we were able to do all 3 things. So how do we protect the capital? We protected the capital because the company was putting money into a policy, enough so that they were able to take advantage of some opportunities. And those opportunities, because of the type of business they're in, there were opportunities to buy a competitor during tough times when COVID hit. They had capital. So what did they do with the capital? They just didn't hunker down. They took it as an opportunity to expand. They kept it as protection for the company. They wanted to retain some key employees, so they had policies taken out on their employees saying, hey, if you stick around, we're going to give you a bonus down the road. But in the meantime, we're going to use that money to expand our business and to grow our business. And so where do they store those dollars? They had the death benefit on the employee, but they used it as a whole life, so they're able to store all their capital inside that policy as well. And then at the same time, we had to have a discussion saying, we have 2 employees and we have to have a fair valuation. So if one of those people dies, one of the owners dies, how do we transfer the risk, and how do we protect the other owner of the business? Because both of them, they got along good together, and their families got along good together, but they didn't know if they necessarily wanted to be in business together. So they had their policies that they owned on themselves or cross-owned on each other. And what happened was they were able to use the whole life, and they would fund it to the max. And so when they needed money to take advantage of opportunities, to buy inventory, to buy out a competitor, to just, maybe meet day-to-day operations when times got lean, which they did during COVID years, even though they took advantage of buying out a competitor. Sometimes the times were lean for them as well. And so they had to reserve a pool of money, which was invaluable. Because everybody thinks, and they see short terms like, oh, what's my rate of return? Well, what's the rate of return on all these other ideas, right? What's the rate of return on being able to buy out your competitors for 40 or 50 cents on the dollar? Because you have capital and they don't, that puts you in a position of authority. So those are just different ideas how I've seen clients use their policies. We got a set of brothers that get along great. They farm. They have policies where they're using to buy equipment. They're using their policies to buy future land. They're using their policies really to unshackle themselves from those entities, the banks and the credit unions that want to control their business by giving the thumbs up or thumbs down if they can expand their business or if they can buy a piece of equipment. Now, it takes time, money, and discipline to make all that happen, to make all these stories happen, because you still have to have discipline to say, I got to pay that payment back. I took a loan. What's my payback structure? I took a loan, again, with the farmers. They've purchased equipment, and the bank sees it as a cash purchase. They see it as just financing through somebody else. And that somebody else just happens to be their own individual entity. So it doesn't take a lot to set up these structures. It just takes a lot of imagination. Saying, okay, how do I take control of that banking function, and then what do I do with it going forward? And if it's hard money loans, if it's buying real estate, if it's investing in your business, investing in your people, whatever it might be, those are the ideas that Nelson has thought through and saying this is the infinite banking concept, because we can be infinite with our thought process. Everybody that reads this or listens to any kind of podcast knows that there's different ways to make money. We all have that different structure. We might all kind of do it in the same industry maybe, but we do it differently. And so it gives you the ability to go out and do it the way that's going to work for you. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.